Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 268 of the Independent Advisors Podcast, where Mark McEvely and I, Matt Jessup, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, we are blessed to have the one and only Nick Whitaker, Director of Research and Trading for the firm Jessup Wealth Management, with us. Welcome, Nick.
Thank you. It's good to be here, as always.
I know you have a lot of good insights, but before we talk about the markets, I know this is a very exciting day for you personally. You want to share with our listeners and viewers what makes Thursday, September 5th, so significant in Nick Whitaker's life?
Yeah, absolutely. Thursday is a very big day. 9/5/2024 is what most people at home are thinking of, the start of the National Football League. The NFL starts tonight. It's the Chiefs against the Ravens, but it's what I think of as the beginning of fantasy football.
Fantasy football time.
Which is very, very intriguing to me. So, big day.
Big day.
Big day.
Did you adjust your lineup in the last 24 hours?
I adjusted my lineup about a week ago. So,
I love it. Well, if anybody needs to talk offline with Nick regarding their fantasy football team or their lineups, you now have some more knowledge about Nick Whitaker being a Swiss Army knife besides the markets.
Yes, I try to have some fantasy football insight. There's always more to learn, but I've done pretty good over the past couple of years. So
love peeling back the onion more and more for the listeners and viewers.
Oh yeah.
Before we get to our discussion, Nick's going to review the month-to-date and year-to-date performance of the major indices that we track. The data is from Y-Charts, and it's going to be as of the market close on September 4th. Nick?
Yeah, so this is from Y-Charts. The S&P 500 is down 2.3% month to date and up 15.7% year to date. The Dow Jones is down 1.4% month to date and up 8.7% year to date. The NASDAQ Composite Index is down 3.6% month to date and up 13.8% year to date. The iShares Russell 2000 ETF is down 3.2% month to date and up 6.1% year to date. And the Vanguard FTSE All-World ex-US ETF is down 1.9% month to date and up 7.7% year to date. Checking in on the Treasury markets, the 3-month Treasury rate is sitting at 5.18%, the 2-year sitting at 3.76%, and the 10-year sitting basically right at the 2-year level is at 3.77%. So
790 days, I saw yesterday, the yield curve was inverted.
Yeah.
You want to, I'm happy to do it, just briefly describe what is an inverted yield curve, Nick?
So what we're talking about that has happened is the yield curve has uninverted. So an inverted yield curve is whenever the short-term Treasury rates are higher than the long-term Treasury rates, indicating that investors are requiring more yield in the short term because the long term is uncertain.
Yep, well said. And so that has inverted after a very long period of time. As I said a couple seconds ago, 790 days. Mm-hmm. For people that are really attuned to the markets, you're going to see a lot of data points and research regarding what happens to the market historically when the yield curve uninverts. And I'm sure we're going to have some content about that in the next podcast. Whoever is on it, I'm sure, is going to be talking about it.
Yeah, I already saw multiple research pieces yesterday coming out about it. So
oh, yeah.
It's definitely a data point that investors look at pretty closely.
Sure. One of those tells, I would say, in the markets.
I will just jump out and just inform listeners that it's not a tell that things are falling apart. The data that I've seen on a year-over-year basis actually is positive. When the yield curve uninverts, the S&P is historically higher.
So it's interesting you kind of bring that up because I got a piece talking about interest rates, and I think what tends to happen is we have recency bias. So whatever happened most recently when this thing occurred, we think it's going to happen again. Mm-hmm. And I have a piece about this when the Fed starts cutting interest rates here in a minute, because you're going to see a lot of this coming up on September 18th. And I think it's no different from the data points you'll see with the yield curve uninverting. And just caution that if you see those types of pieces, don't make investment decisions solely based on a single data point such as that.
Yeah, absolutely. Never make investment decisions based on a single data point.
But however, some of
a good rule of thumb.
some of these headlines make it appear as if it's a silver bullet.
Absolutely.
Right?
It's yeah.
Nick, you want to start off with our big headlines and current events for our listeners and viewers?
Yeah, absolutely. Just a few headlines. Shortened week, obviously, following Labor Day. So Tuesday, which is the 3rd, stocks fell. And the VIX jumped to 22. So it kind of felt like a little bit of a painful day. I really saw the trade a little bit more as a consolidation and profit taking. Kind of jumped on Friday and just kind of unwound. So you'll see some news about that if you haven't. The Fed's preferred measure of underlying U.S. inflation rose at a mild pace in July, while U.S. consumer sentiment also improved. So on the economic data front, everything is looking pretty good, continuing as expected. A big headline that you're going to see as well is Nvidia received the DOJ subpoena in an antitrust probe. You're going to see that across all types of reports, mainly because Nvidia in and of itself has been in the news a lot.
Yep. It's one of the largest market cap stocks.
Right. Yeah. And a leader of this AI trade in a lot of ways.
Sure.
Do you want to give your take on that for listeners? I'm sure they'd be interested to hear what you think.
Well, I'll start with this. There's a lot of individuals I've seen trying to assimilate an analogy of the Microsoft antitrust probe in the 2000s versus Nvidia. I think it's quite early to say that that's the case. I'm going to overly simplify it that Nvidia holds a lot of intellectual property and patents to a lot of this technology related to graphic cards. And it just so turns out GPUs. And it just so turns out that GPUs are a key factor in AI related computations compared to the CPU or the computer processing unit. So I'm sure that them looking into it, and if it comes to fruition, I think it would be very difficult to break up such a company. I'm just shooting from the hip. I'm not an expert in this area of antitrust, but a little different from Microsoft that had a lot of different business parts at the time compared to Nvidia, which just literally, they have a little software, but it's predominantly chips.
Yeah.
And I think it'd be very tough to kind of slice and dice that pie.
Yeah.
So we'll see what ends up coming from it. Could be just headlines, or it could be more to it, but I think only time will tell.
Yeah, I agree. I think right now it's just headlines, and the market didn't react aggressively to it. That tells me a ton.
Oh, well said.
When a headline comes out like this and the stock is relatively unchanged related to the news, that's telling you investors are not
overly concerned.
Not overly concerned. Of course, we'll monitor it.
Yeah.
But that was my initial thought when I see the headline. I'm thinking, what are they going to do? Like you said, they have the IP property on the,
Yeah, it's tough to go against that. I'll just throw out one last thing. Just a reminder for our newer listeners and viewers, anytime we talk about a specific security such as Nvidia, it's not a recommendation for or against that specific security, just that obviously they're in the headlines.
Yep, absolutely. And then the last headline just to be aware of is that the jobs report is going to be released this Friday. That'll be a big number, or I should say that'll be a big report. Investors obviously will follow that closely given where we are in the cycle, and the Fed expected to cut interest rates in September. So, if the jobs report comes back strong, that could cause a little bit more volatility. So we'll see what happens.
Yeah, I think we're kind of in this environment where people are judging the economic data in this way. If it comes in soft or lighter than expected, the market is expecting the Federal Reserve to potentially do a bigger interest rate cut on September 18th. Yeah. If the data comes in stronger, the market would expect the Fed to do a smaller cut because there are a lot of Wall Street predictions either 0.25% or 25 basis point cut, or a 0.5% or a 50 basis point cut. And there seems to be some division on Wall Street as to which way the Fed's going to go. And obviously, if the data continues to come in either strong or light, that could affect the Fed's decision in a couple of weeks here.
Absolutely. Very well said.
Okay.
You want to take us into tweets and articles and research?
I do. So the first piece, Nick, that I want to highlight is in regards to the forward-looking rates of return for the S&P 500 index after the Federal Reserve makes its first interest rate cut. I want to get well ahead of all the headlines that our listeners and viewers are going to see in a couple of weeks. And so, again, I'll provide the facts, and then we can give our opinions regarding that data set. So the first piece I'm going to reference is an ex-post by Mike Zaccardi, a friend of the podcast, CFA and CMT, on August 29th. He's referencing this chart that Jenna will put up for our YouTube viewers. This will be in our show notes and all of our social media sites, Facebook, LinkedIn, X, etc., that shows the data. The source on this is Schwab, Nick, and it shows, again, the forward-looking rates of return for the S&P 500 index 12 months after the Fed makes its first interest rate cut. You're going to notice here very quickly, we got roughly about a baker's dozen data sets, and the first data set is 1929. Now, what you're going to see that stands out here is of all these times the Fed starts cutting interest rates, 2 of these data sets have a negative rate of return that have occurred over that following 12-month period. And if you remember my comments at the beginning of the podcast about recency bias, there's a lot of people on Wall Street that are going to quote what happened to the market in 2001 when the Fed started cutting interest rates in 2007. And I think you're going to see a lot of assimilation that when the Fed starts cutting, that must mean the market's going to struggle for the next couple of years. What I want to do is I want to take a step back and I want to look at it from this lens. We got to realize that there were some extraordinary events occurring in 2001 and 2007 that I think muddies the water from making it very clear cut, like I feel people are going to try to make it in a couple of weeks. We got to remember, 2001, we had 9/11 that September. They started cutting earlier that year. In addition, you had 2007, you had a great financial crisis that bled into 2008. So the reason that I want to highlight this is I really feel you're going to see headlines that are going to assimilate once the Fed starts cutting interest rates that instantly spells doom and gloom for equities. And when you take a data set and you look at it, not just in the past, say, 2 decades, but you look in the past roughly 8 to 10 decades, what do you see from this data set?
Yeah, it's overwhelmingly positive. And I 100% agree with you. I think come September, or I should say later in September, you're going to see a lot of headlines about this and doom and gloom and, oh, the Fed's going to cut, so the market's going to fall apart. There will be volatility and there will be pullbacks, I'm sure.
Sure.
But the data speaks for itself, and this chart is very clear that statistically it's overwhelmingly positive, and huge asterisks next to those 2001 and 2007 downturns because of the economic situation at hand, particularly 2007.
Absolutely.
Right? But even 2001, you're coming off of the few years prior with the dot-com volatility, so there's a lot more angst in the market, and
the market closed for a week after 9/11. I mean, there's a lot of extraordinary events.
Yeah, so you can understand how there's much more angst in those times, and I don't see the angst in this market relative to those time periods. I would think that this market and economic cycle is actually looking very healthy, and the economy is contracting, but healthily.
Now,
right?
You set me up perfectly because I have a follow-up chart for you. I don't think you've seen this data yet.
I have not.
So my next chart is from Schroders. This was also in Mike's post that he had. And what they did, Nick, is they slice and diced the data to show when the Fed made its first cut, were we in a recession or were we not in a recession? Pretty interesting, right?
Yeah, that's important.
So Jenna will put up this chart for our YouTube viewers because you just alluded to it a couple of seconds ago. So if you look at the bottom of this chart, and we'll verbalize for our traditional podcast listeners, the average return for the U.S. stock market, according to Schroders research, when there is no recession over the next 12 months after the first cut, 17% positive. And if we're in a recession, 8%.
Yeah, that makes a ton of sense to me.
So let's go back to just real quick, because this is important. We've been talking over the past roughly 2 months about the current state of the American economy, because there was a lot of headlines in July about the possibility or fears that a recession was very imminent at that point. And when you look at the data right now, the latest data I saw from a couple of days ago was from Goldman Sachs, and they think we're on pace on an annualized basis for third quarter GDP 2024 in the mid 2% range.
Yes.
The technical definition of a recession is 2 consecutive quarters of negative GDP growth. Okay? At some point, we are going to have another recession. We had a technical recession in the first half of 2022.
Yeah, which is what Mark and I have talked about, I think, recently. That is hotly debated.
Yes.
And that's one of the reasons, is because it didn't really feel like a recession because unemployment didn't go up.
Yes.
Continue.
Yeah. And so my point here at the end of the day is I'm not seeing a recession at this point imminent, which would make me want to favor the data set of average no recession. Now, does that mean we are guaranteed a positive return over the next 12 months in the markets? Absolutely not. We're not going to be guaranteed that. Yeah. Okay. But
if only.
Yes, which would be great. But when you look at the data sets, it is something to be mindful of. And so I think that as people continue to watch the economic data, if we're not going to have a recession in the next several quarters, that's just another piece on the positive or the tailwinds for equities that I think investors should just be mindful of. Good way of saying it?
Absolutely. Be very mindful of that. You
Okay.
know, it makes a ton of sense too when you think about that just conceptually.
Yes. I want to lay that out.
Interest rates will be higher. So when you're in a healthier environment and the Fed has more room to cut and they're not trying to catch up in a doom and gloom scenario, there's more positives that there's more areas that investors can rotate money. Companies are going to be healthier. So it makes a lot of sense when you think of it that way.
You are teeing me up perfectly. So I'm going to go to my third piece because it perfectly aligns with a couple of comments you just made.
Nice. Not planned.
This is not planned. So my third piece I had was, what is the current market expectations for something called the terminal rate? The terminal rate is what the market is expecting rates will drop to and where the Fed will hold them steady. Okay? So to give a little bit of education deeper for some of our listeners and viewers, right now the Fed funds rate is in a range, a stated range, Nick, of 5.25% to 5.5%. And it will fluctuate in that range. Right now, and this data is from B of A, and this was a post that I saw, and the date on this post was very recent. It was on September 3rd. And what it shows is the market's expectation for where rates will eventually settle, the terminal rate, is around the 3% range, is the expectation. And they're expecting that sometime in early 2026. Jenna can put up this chart for our YouTube viewers. This will be in our show notes. I just want to throw this out there because there's also, I think, some feelings that the last time the Fed cut rates, they literally pretty much went to zero, both times.
Yeah.
And so I think there's that recency bias. Well, they did it the last 2 times. Rates must go back down to zero again.
Yeah, I think that would be a huge mistake with the economy as healthy as it is.
So I want to throw this out there and get ahead of it that this assumption by the market will continue to change as the data comes out.
Of course.
This is where it stands today. But I want to throw it out there that it's just not a certainty that rates go from over 5% to a sub 1%. It could go from 5 to 3, as the market is expecting now, as an example, and they could hold it there.
Yeah.
So I just want to throw that out there that there's a lot of people just, I think, who will assimilate, oh, they're starting to cut. That means they're going to go all the way down to under 1% like they did the last couple of times they did it. Not necessarily going to be the case.
And to add on to your point, that gets to recency bias, because the last couple of times they did it, they really had to go that low because of the extremes of the economic situation.
Which goes back to your point earlier about trying to disseminate the data sets, that when the Fed starts cutting, are there extraordinary events? Are we already in a recession? And they're trying to play catch up, pump that patient full of medicine to make them feel better.
Medicine being low interest rates, which
cheap
is
money,
essentially cheap
lots of
money.
liquidity in the system.
Yeah.
This has been a good conversation.
Yes,
We're giving a
this
TED
has.
Talk
Yeah,
here.
we are.
All right. So my last piece, and I'll turn it back over to you, is a reminder about seasonality. I know I kind of sound like a broken record, but I want to get just well ahead of seasonality. And the market has been acting, in my opinion, quite normal for a presidential election year. And for our newer listeners and viewers, what I mean by that is, if you slice and dice the stock market historically based upon year 1, 2, 3, and 4 of the presidential election cycle, when you go into these presidential election years, Jenna will now put up this chart for our YouTube viewers. This will be in our show notes. You're going to see here very quickly that September through, say, the middle of October, at a historical seasonality basis, tends to be weak for the stock market. Doesn't guarantee it, but I just want to go into it that if investors see weakness later in September and early October, that would not shock me by any means. Good way of throwing it out there?
Absolutely.
And the source on this is Zero Hedge from September 4th for the record.
Absolutely. And we'll take us back to the pricing at the beginning of the podcast. Wouldn't shock me even more because we are up healthily year to date. The S&P up 15.7% year to date. We've had a little bit of a pullback month to date. That makes sense.
Yeah.
Consolidation, profit taking.
Yeah. I mean, there's people out there who are arguing, well, the weakness that we would normally see in September and early October got pulled forward in July and August. That might be true. It might not be true.
Yeah, perhaps.
So, Nick, I will turn it over to you. What do you got for listeners this week?
Yes, I have a few pieces here, and they're actually all from Charlie Bolello. I was reading a piece of research from him yesterday, and he did such a good job that I just thought I'd include a segment of his entire research piece. So
great.
The first one is discussing, will the AI arms race pay off? There's a chart here that talks about CapEx, capital expenditures, the spending increasing over the last year pretty drastically. And I think it's a helpful chart for listeners to understand how much some of these top tech companies are spending to kind of set themselves up for success with the AI arms race, quote unquote.
This will be interesting.
Charlie says the following. Nvidia's the few pieces of research before this was discussing Nvidia, obviously with the GPUs we talked about earlier. They benefit from AI technology because to operate a lot of AI technology, you really need the graphic cards. You need the
run the
GPUs.
computations.
So he says he's talking about NVIDIA's historic advance, and he says NVIDIA's historic advance over the past few years has been a direct result of the AI arms race, where the biggest tech companies are making some enormous bets on the future. Google has increased CapEx by a whopping 91% the last year. Amazon, Microsoft, 55%. Meta, 33%. Have also significantly boosted their spending. Google CEO recently said the risk of underinvesting in AI is dramatically greater than the risk of overinvesting. Meta's CEO Mark Zuckerberg said he would rather risk building capacity before it is needed rather than too late. While Nvidia is clearly benefiting from this trend right now, which we've seen in the stock price, of course, and the revenue and earnings, et cetera, which we talked about a couple of podcasts ago.
Yep.
The question for investors more broadly is how much return on investment other companies will experience from their AI infrastructure build out, and when will we see that translate into higher profits? Do you have any thoughts on that? We'll throw the chart up here just to kind of show.
this might be a hot take, but I will share it. You've seen a lot of announced layoffs in the tech sector. I think if you start slicing and dicing the math on layoffs across industries, surprisingly, a lot of them have come in the tech sector.
Oh, yeah.
And I think you are now seeing some of the productivity gains of entry-level programming jobs, as an example, being now utilized by proprietary AI software that these companies are developing. And so, I think that is a huge advantage for these companies specifically. And again, I know it's a hot take because, that affects the broader economy on a short-term basis. But I think, shooting from the hip, that's the first observation, is if you asked me the question, Matt, where have the most layoffs been announced year to date? Tech.
Yeah, hands down. Yeah.
And I think that just when you look at that, I think you are seeing, if I were those companies, I'm sure they're running the math every month and every quarter. I'm sure that they're already seeing a return on those investments.
Which is probably why they continue to invest.
Which it is.
Food for thought. That takes us into the next piece, just a continuation of Charlie's research here, which is going into looking at valuations and thinking about, hey, how does that increase in tech spending impact the underlying earnings, which impacts the price to earnings ratio. So he says, in looking at valuations, the expectations here seem quite high. The S&P 500's price to peak earnings ratio of 25.7% is 49% above the historical median and the highest we've seen since 2000. And there's a chart that we'll throw up here that just shows you the S&P 500 price to peak earnings ratio. So essentially, this run up on the AI trade that we've seen over the past, let's call it 2 years, is more built into price appreciation than we're actually seeing technical earnings growth from a lot of these big spenders that we just discussed. And the question is, when are we going to really see the earnings follow?
There's expectations of it.
There's high
earnings
expectations.
Growth. Are we going to see those numbers?
Charlie follows up and says, this is my third piece here. The bet investors seem to be making. The huge AI investments will start paying off in the coming quarters, with the S&P Dow Jones forecasting a 26% increase in the S&P 500 earnings by the end of 2025.
That's bold.
It is bold, which is why this is important. If that actually happens, one could argue that the current valuations are justified. But if earnings fall far short of these lofty expectations, a painful revaluation may occur.
Very important.
We'll throw up this third chart here. That's the S&P 500 operating EPS trailing 12 months. And you can see kind of the estimates through 2025. They're quite up there. And this will be a really big story for earnings that people will be watching very closely. To make sure those investments are paying off and to make sure investors understand where that CapEx is being spent and how it is flowing down to the bottom line. And I think these three charts and the research that I read the past 2 days on this is an excellent summary of kind of that whole story. Put the rate environment and the economy all together, and a lot of it just makes a ton of sense.
Perfectly said. A couple things stand out at me that I want to go over just one more time. So right now, just so we're clear, Wall Street on average is expecting earnings per share to be specific, EPS, to increase 26% by the end of 2025 than where we are at today. And you got to think about how big these companies are and the revenue that they're generating. And to see those types of gains on average would be huge. And it goes back to what you said. You have these, relative to history, high valuations on stocks. Are they justified? So as these companies, and this is the educational side of it now for our listeners and viewers, every quarter as these companies report earnings to shareholders, that is why you see these big volatile days in a name, because they're unveiling to their shareholders, okay, in the past quarter, this is how we performed. You've been in the cold. This is what we did. And what this is indicating is you better be beating those lofty expectations or your stock is going to be punished.
Yeah, absolutely.
In the short term, at least.
In the short term, yeah.
Is it a good way of throwing it out there?
Yeah, and when we say punished, think repriced.
Repriced.
Right?
Repriced.
Investors are saying, oops, we bought this a little high for what the earnings actually came in at.
For the fundamentals at that point.
Right.
And my last point I want to make to our listeners and viewers is in regards to this. If there's one thing that I've learned being in this industry, and now I'll be going on over 25 years in the financial services industry, in my opinion, there is a big correlation between earnings growth and a stock's performance. If you have a company that is consistently growing earnings, there is a high correlation historically to the stock's performance. Okay?
I almost grabbed a research piece on that exact thing, but
well, next time we're together.
I went with these instead.
Next time we're together. And so the reason that's important is when you see the underlying performance of corporate America, just in general, this healthy, it wouldn't surprise me to see the market do okay over the next, say, 12 to 18 months. That's not guaranteed because these estimates could fall short.
Yep.
But if they do come to fruition, in my opinion, with my experience, there's a high correlation between earnings growth and stock performance, something I think investors should just be aware of.
Yeah, and hypothetically, even if they do fall short, this is really just one section of the market that we're focusing on. Let's say they fall short, repricing does occur. Investors can rotate to other areas of equities, which will support the benchmark and move the market higher.
Could, absolutely.
That can happen too, for sure.
It could.
Yeah.
Well, I know we're going to invite Taylor Ledbetter to talk about the financial planning topic of the week before Taylor joins the podcast, Nick. And before we let you go, any other final thoughts you'd like to share with our listeners and viewers? Fantasy football, markets. We got the first presidential debate coming up now.
Fall's an exciting
next Tuesday.
Fall's an exciting time, but the only thing I will say for listeners is that we're hoping that the Chiefs wide receiver Rice is in the end zone a couple times tonight
to pump your fantasy week up.
That's the fantasy guy I'm cheering for tonight.
You know you're going to get some emails now over this.
All right, thank you.
All right, Nick. So, listeners and viewers, we're going to transition. We've had quite a heavy load of data and research that we wanted to share. So we are very blessed to welcome back Taylor Ledbetter to the podcast. Taylor is our financial planner and paraplanner here at the firm. Welcome, Taylor.
Good to be back.
So, Taylor, what do you have for our listeners and viewers this week?
Yeah, so today I just want to talk about costs in retirement that maybe people don't really plan for. Some can be kind of surprising, and just how that ties into saving for retirement.
It's interesting you bring this up because just in the past week, I've had 2 conversations with clients who are getting ready for retirement. And one of their areas of anxiety, Taylor, is in regards to what their budget is going to look like in retirement, right? So I think this could be very good. I'll be sending some follow-up emails to these people saying, hey, check out podcast 268. Taylor had a good piece on this. So I'll turn it over to you.
Perfect. So the article that I'm going to be referring to, it's from newretirement.com.
Okay.
And so the first cost or expense it talks about is, they call it the fun stuff.
The fun stuff. I like that.
So it says, it may seem surprising, but people are apt to leave the fun stuff out of their projected retirement budgets.
Okay.
This includes traveling, hobbies, gifts for, friends and family. Traveling, that can be very expensive.
It can.
That's one question I always, ask to clients when talking about retirement is, do you plan on doing a lot of traveling? Sometimes they say yes or no.
Yes.
Gifts for friends and family. I think with that topic, it's really common for grandparents to gift for their grandchildren's education. I see that a lot too.
Absolutely.
And those can all be very pricey things.
Depending upon how much they want to do, yeah.
Yeah, exactly. Maybe I've also talked to people who, golf in retirement. Maybe they're on some type of league going from state to state.
That can get expensive really quick. Yes.
And I think sometimes people don't really know how to budget that type of stuff in because maybe they haven't thought about it. They don't know how they're going to spend their free time when they retire.
Well said. Well said.
Next, we have inflation. So the article says the one benefit of the currently high inflation rate we have all learned or relearned is that inflation can be a big deal, especially after retirement when your fixed income and resources may not keep pace with the increased cost of goods and services. And so with this, something that sticks out to me is people who are living off of Social Security.
Yes.
Because, of course, there's a cost of living adjustment every single year.
Yes.
But as we've experienced over the last couple years, it doesn't necessarily cover everything.
That's right. And anytime I give something called like a retire ready presentation to various different groups. And one of the points that I always like to make, Taylor, is in regards to individuals who are overly conservative with their investments when they retire. And you would think it'd be the opposite, right? But what I see is when we're in such a high inflationary environment, what people are not accounting for, and let's go back a couple of years when we had that really high inflation rate. It's called about 9%. This is the example I like to give. If you got your statement at the beginning of the year and it showed that you had $100,000 in the account, let's fast forward to the end of the year. At that point, banks were not really still paying a ton in interest. So I'll be conservative and let's just say it said $104,000 at the end of the year with some interest. If on that statement at the end of the year, it said your purchasing power because of inflation is now $96,000 or $95,000, do you think that individuals might look at that through different optics? And the reason I'm using this as an example is if the average individual is retiring in their mid-60s, statistically speaking, they're going to be in retirement for upwards of 30 years. And so you got to think about what is going to be the purchasing power on this money if your overall liquid net worth is too conservative. I'm not advocating for people to get ultra aggressive, but if there's zero equity exposure, you really have to question what is going to be the purchasing power on that money or some sort of exposure that can be an inflation hedge a decade plus later. That's just a big point that I make because it's easy to have the conversation of you retire and you're too aggressive, pull back on the risk. That's an easier conversation. But when you have an individual who's overly conservative and they're so concerned about short-term events that if I can get them to think about not what's going to happen with the election, not what's going to happen in even whoever wins this presidency in the next 4 years, but where things are going to be 1-2 decades from now, then you start to derive, I think, different, say, investment allocations. Make sense?
Yeah. Yeah, you definitely have to find that happy medium between not being too aggressive or too conservative.
Yes.
And it's really easy when the market is having downturns.
Yes, to justify your conservative stance.
Exactly. But that's, in my opinion, I think that's one of the worst things you can do.
That's why you got to have a longer term time horizon with anything that's a risk-oriented investment.
Exactly. I mean, it's all psychological. But
It is. It is.
So the next topic is going to be future maintenance costs. So the article says if you own a home or a car, you're going to have to maintain those assets just like you did before. The roof will need work at least one more time. You could roll another 50,000 miles on your car.
Yep.
And these can be pretty big, lump sum withdrawals at one time that you're going to need.
Yeah. My words of wisdom, when every time this comes up, and I know you probably have a similar stance, Taylor, when you provide this advice, if you take like the average decade in the market, you're going to have 2 or 3 really good years where returns are above average. And I would take those 2 or 3 years as the opportunity to look at those deferred maintenance areas of your life, whether it's the home or your automobiles. And maybe you take a little bit extra in withdrawals those years, and you might not do it in that year, but you segregate that one way or another. And so my words of wisdom is in those really good years, start really thinking about what's on the horizon on these unexpected expenses. Make sense?
Yeah. Yeah. And I know we've talked about before, the rate of withdrawal that we recommend taking from accounts is about 5% of the account value.
Yes.
So I would say, those really good years would be, high single digits, low double digits. It depends on a lot of factors.
Yeah,
but
depending upon the return and their withdrawal rate. But again, those are your years to kind of catch up with those future maintenance costs that aren't in your budget.
Yeah, exactly. The next item is just emergency and other foreseen costs, which I think kind of ties into those maintenance costs that we just talked about.
Yep.
So the item after that is going to be taxes. And I think taxes become a little more problematic for some people when your RMDs kick in at 73.
Yep.
I don't really foresee it being a huge issue early on in retirement, but, planning to help minimize your tax liability once those RMDs do kick in.
For our newer listeners and viewers, 30 seconds or less, what is an RMD?
So RMD stands for Required Minimum Distribution. It starts, as of right now, when you turn 73, and you are basically required to take out a certain amount of money every single year from your pre-tax accounts, so
Yes.
like an IRA.
Correct.
And you have to do that for the rest of your life.
Correct. And that's all ordinary income. Yep.
Yeah, and so it's based off of two factors: the amount you have to take, the account value, so the size of your account, and then a lifetime expectancy factor. So I've seen some RMDs be pretty large, and if you have to take all of that out at one time, you're going to have a pretty big tax bill.
And you really can't control that, right? So if you have to take that, it's ordinary income. There's kind of no way to get any sort of preferential treatment in layman's terms on those, right?
Right. Yeah. You have to take it.
Yep.
There's, a couple of things you can do to help minimize or maybe prevent that tax blow.
Sure.
So a Roth conversion, I know we've talked about that a little bit before on the podcast.
Yes.
That essentially just helps, move money to a Roth account, a tax-free account.
Yes.
And then by the time you get to RMD age, your pre-tax account balances are a lot lower.
Yes.
Essentially.
Yes.
And then QCDs stand for Qualified Charitable Distribution. So you can do that once RMDs kick in. Just donate to a charity of your choice, that RMD amount, and you don't have to recognize income or taxes on that.
So a real life example is, let's say you are 73 or greater, and let's say that you give to charities or say a religious organization. So I attend a United Methodist Church. Instead of kind of writing my contribution, if you so do so, from my, say, checking account, might be more efficient potentially to do that direct from your retirement account right to that church in my example, right?
Yeah.
So I think that's a good reminder for our listeners and viewers.
So the next 3-4 items I think are pretty important, and these items I think are maybe the least thought about or thought about too late.
Okay.
So next we have long-term care or health care. So long-term care, it's not normally covered by Medicare.
Correct.
Rates will vary by location, but Genworth Financial, they did give some national annual average costs for long-term care. So on average, adult daycare is about $20,300 per year. A private one-bedroom and assisted living is about $54,000. Homemaker services is $59,500. For a home health aide, it's $61,750. For a semi-private room in a nursing home, it's around $95,000. And then for a private room in a nursing home, it's a little over $108,000.
Yep.
So these are obviously very expensive annual costs. And a lot of times what I notice is people will ask about long-term care once they're kind of already in retirement or it's close to that time.
Yes.
And by that time, there's really not much you can do.
Almost cost prohibitive per se, right, to get the coverage. It's interesting. My immediate thought as you were going through this, Taylor, is this trend I'm seeing again of generations moving back in together. And I think there's tons of reasons for it. One of those is the younger generation. We're getting back to the point again where the younger generation's taking care of the older, where that wasn't really a trend that I saw for the last couple of decades, but I'm seeing it again. There's other reasons, inflation, but this is one of those reasons too that I'm seeing.
Yeah, and that was actually another cost on this list. It's the last one.
Oh, okay. I did not know that. Okay.
Yeah, so it's referred to as the sandwich generation cost.
Okay.
So it says usually this is for or conducted by baby boomers, people who are caring for their elderly parents and also maybe supporting adult children.
Okay. Yeah.
So according to a study from the American Association of Retired Persons, 32% of midlife adults age 40 to 64 provide regular financial support to their parents or have in the past year.
32%.
That's pretty high, so you nailed it.
Okay. You got a stat now behind it.
And then 42% expect to be doing so in the future. And then it says half of midlife adults are still providing money to their adult children aged 25 or older, approximately 51% for basic expenses.
I knew that the numbers were up there, Taylor, but I want to be very transparent. They're a lot higher than I expected the data to be from AARP.
Yeah, no, I read that and I was kind of surprised to hear the numbers were that high.
And I think a lot of times, I'll just use an example of our wealth management practice. We're very, very close with our clients, but sometimes clients don't fully confide in how they're spending their day-to-day money, right, and their living expenses. But I just think with, the way society is today, I mean, look at the cost of owning a home compared to 2 decades ago. I know you see these stats all the time, Taylor. When I start, taking all that into account, it doesn't surprise me to see these numbers so large.
Mm-hmm. Yeah, and I think you see it a lot too with, again, maybe older individuals just living off that Social Security.
Yeah.
Their children helping them out.
Yes.
College expenses for their kids.
Yes.
Student loans, all of that.
That's right. Buying that first house, when they start having kids. Yeah, a lot of big life events.
Yeah. So it's unfortunate that number is so high. Hopefully that will come down, but I guess we'll see.
I think what this leads me to is I think the trend of generations living together, I would argue that trend is probably not going to stop anytime soon.
Mm-hmm. Yeah, unfortunately.
Yes.
Just have a couple costs left. The next one I think it's something I see a lot. I think it's pretty popular, and that is retiring sooner than you expect to.
Mm-hmm.
So the article says if you're forced to retire earlier than expected, you're faced with those extra years for which costs need covered for your retirement. And then some stats from the Society of Actuaries found that today's pre-retirees, they plan to retire at older ages, but the actual median retirement age is 60. Yet 2 in 10 pre-retirees say they plan to work until about age 68 or don't plan to retire at all.
Yeah, it's interesting you bring this up because I think boots on the ground, I know you probably see it very often in your one-on-ones with individuals, Taylor. People get to their early 60s and they start thinking, okay, I could sacrifice another, let's use this example, 8 years of my working life, but I would rather take less income annually the rest of my life and do these things while I'm healthy and young. And I think what they start to see is, maybe, parents telling them, I wish I would have, you need to retire earlier, take advantage while you're healthy, do those things you wanted to do. And obviously, if anything, put that more front and center about what's important to people, it was obviously during the pandemic, right? And people did a lot of self-reflection. And so that doesn't surprise me at all, but it's nice to see some stats behind it.
Yeah. Yeah, because as you get older, I've talked to people who as early as 55, maybe they were planning on retiring at 65
Yep.
and they're 55 and they just don't know if they have it in them or they just want to be done.
That's right. And they're willing to accept less income the rest of their life to get those 10 years of their non-working life back to them.
Yeah. And yeah, sometimes another thing that people do that's popular is they do retire early like that and they go work part-time and do something just to cover those extra costs, because if you do retire before 65, you're not eligible for Medicare yet.
Yep.
And that can be pretty expensive. And if you're planning to retire at 65 and then you change your mind, you haven't accounted for that cost. It changes a lot of things.
Yeah, it's a great roundtable within itself because, again, you got to cover those healthcare costs. I know a lot of people might not look at retirement as working at all, but I would argue more and more people are viewing retirement as I'm working part-time. It's on my terms. And I am seeing more and more of that, and I'm sure you are as well.
Yeah. And then the last cost this article talks about is longevity. So it says life expectancy in the U.S. has soared from 70 years in 1971 to around 80 years in 2020. Advances in medicine could keep those in their 40s and 50s today alive well into their 80s and 90s. Extra years that extra costs have to be planned for.
I think this is a biggie people do not account for, Taylor. They really don't.
Yeah, but then again, that's why we recommend that 5% rule when withdrawing from the accounts, because the account should be growing, more than 5%. Again, that's where you have to have that balance of being not too aggressive, but not too conservative. So I think as long as you're not overspending every year, it shouldn't be too big of an issue.
I love this. And I'll just want to throw out one last point. Boots on the ground. I'm seeing a lot of our client base live to their young 90s, right? I'd say that's an average. And so I think a lot of people assimilate, well, XYZ relative, whether it's a parent or a sibling lived this long. So I think I'm going to be along the same wavelength, and that might not be the case, right? You might live a lot longer than you think, and you got to plan for that, like you just insinuated.
Yep.
This is a good piece this week, Taylor. I like this.
Yeah, I thought they were interesting. I mean, some of the points were kind of basic, but I really liked the sandwich generation costs.
Yeah.
I thought the retiring sooner than expected was pretty interesting because, again, I see that a lot.
I'm going to use this again in the future, that when I'm speaking to clients who have that pre-retirement anxiety about their budget, again, I think it's easy to know this is what I'm paying in my electric bill, my water bill, my cell phone. But I think their anxiety is in these unknowns. So I'm definitely going to reference this podcast in this portion of the financial planning topic of the week, because I think it is very insightful that these topics are areas that they're not thinking about.
Yeah, hopefully it puts these topics on people's radar, who are close to retirement.
Well said. So before we sign off, a couple of things. One, we use our podcast hosting site that's called Blueberry. That's spelled Blubrry. If you want to create your own podcast, you can go to their website, use the promo code JessupWealth to get your first month of Blueberry podcast hosting for free. You can go on there, choose your ideal plan, use their hosting estimator on their website. Again, you can receive your first month free with the promo code JessupWealth, all lower cases. And in addition, if you're looking for a good piece of AI software to help you note take and summarize a meeting, we highly recommend Firefly's AI software. You can use the link in our show notes below to purchase your subscription and make life a little bit easier. Before we sign off here on episode 268, any final thoughts, Taylor?
No, it's just going to be a next interesting couple of weeks. With the Fed, they have their meeting mid-end of September and then election right after that. So, I think it's going to be good.
Yep, I think it'll be very interesting. A lot of headlines, especially as you said around that Fed meeting on September 18th. I think it'll be important. The announcement that day is at 2 p.m. Eastern Standard Time. So we'll go ahead and sign off. Thank you for listening to episode 268 of the Independent Advisors Podcast. Myself, Taylor, Nick, Mark, Aaron, Jenna, appreciate you guys listening in. And we'll be back next week with episode 269.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.